Over the last 2 years, small cap mutual funds have become extremely popular. Some funds have doubled the wealth, while others gave return higher than large cap and mid cap categories. But here is a catch. Small cap funds are showing the signs of overheating in the market. That is, too much money chasing too few stocks can push prices up sharply, creating risk for investors. Now, what does this mean? In simple terms, small cap companies do not have large market capitalization. So when lakhs of investors pour money in small cap funds, the prices shoot up sharply. SEBI, who regulates the market, fears that this could create a bubble. And when the bubble bursts, investors, especially retail investors like you and me, could suffer the losses. In this video, we will check India's growth story and why small companies matter. What are small cap companies and the benefits they offer? How to plan your investment strategy in small cap. Important pointers to remember before investing. Plus, by the end, we will also look at some of the top performing small cap funds you can consider. Namaste friends, I am Rohini and you're watching the knowledge series of Fincash.com. India's SMEs, that is small and medium enterprise, already contributes 30% plus to India's GDP and employ more than 11 crore people. With Digital India, Startup India and PLI schemes, many of these small firms are scaling rapidly. Some will move into mid-cap territory and few will become tomorrow's large cap. So when you invest in small cap funds, you are betting on India's entrepreneurship and tomorrow's growth story. Let us look into what are small cap funds and what benefits do they offer. Think of companies listed in stock market as a cricket team. The large cap companies are like Sachin Tendulkar, Virat Kohli or Rohit Sharma. They are well established, proven and everyone knows about them. The mid caps are like upcoming stars, Shubham Gill, Rishabh Pant. They are not legends yet, but it is quite clear that they are coming up. And the small cap? They are like Ranji Trophy players. They are full of potential, but they are not yet tested at international level. A small cap mutual fund is a basket of these small companies. By regulation, fund managers must invest at least 65% of their money in small cap stocks. That is, companies rank below the top 250 on stock exchange, usually with a market capitalization between 500 to 5,000 crores. Some of the small cap companies are 3M India, LIC Housing, Apollo Tyres, Tata Technologies, TVS and so on. So when you think of a small cap mutual fund, think of it as a difference between your local Kirana shop and national wild retail. The Kirana store today is small, but if it scales up, it can become tomorrow's DMart. So why do people invest in them? Because it is one of the Ranjit players that can become tomorrow's Virat Kohli or Sachin Tendulkar. And if they become so, the returns can be extraordinary. But at sometimes, many don't even make that big. And that is where the risk lies. Now, let us talk about why small caps have rallied so much in last 2 years. So the strong growth in India's SMEs and startups combined with rising SIP inflows and institutional interest has pushed many small cap funds up sharply. And the result was some funds have delivered return well, that is above large cap funds in couple of last years. In 2023-24, many small cap funds delivered return over 35% compared to 18 to 20% in large cap funds. But here is the reality. Small cap rallies are not new. Back in 2017, this skyrocketed. But by 2018, they crashed nearly 40%. So let us now look into real opportunities that small cap funds give. Small cap companies can be tomorrow's giant. You remember Infosys? In early 90s, back then it was a tiny IT firm, but today it is a global powerhouse. Or for that instance, DMart, which started as a small retail chain before becoming a stock market favorite. This is the essence of small cap. If they are executed well, they can grow into 10x, 20x and even 100 times. If we zoom out and look at long term, the data is very clear. The Nifty Small Cap 250 Index has delivered around 50% CAGR since reception, compared to large cap that is 12%. Now 3% may not look that much, but let us compare. 10 lakh invested in large cap for 15 years grows to about 54 lakh. The same in small cap, they nearly grow into 81 lakh. That's the compounding power of small cap. First things first, define your goal very clearly. This is where most investors go wrong. Small cap funds are extremely volatile in short term. They can crash 30 to 40% in a single year. That is why it is not suitable for someone who is looking for short-term returns, that is for 3 years or 5 years. Even AMFI and SEBI caution that small cap funds are meant only for investors with a long-term horizon and high-risk appetite. In fact, most fund houses mention in the fact sheet that the recommended holding period is 7 to 10 years. So before investing, ask yourself, do you really have that much time and patience to invest in small cap funds and keep it holding for 7 to 10 years? If your answer is no, stay away. Now, if you ask why systematic investment plan beats lump sum in small cap, it is because small caps behave like a seesaw, sometimes up, sometimes low. So if you invest every month a fixed amount through SIP, here is what happens. When market falls, your 10,000 buy more unit, like shopping in a sale. When market rise, the same 10,000 buys fewer units, but your older units grow in value. This is why systematic investment plan makes you invest more when markets are cheap and less when they are expensive, automatically without you stressing over time. Let's look at the example. A SIP of 10,000 every month since 2018 in a good small cap fund survived a 40% crash in 2018 and still delivered 18 to 20 CAGR by 2024. And with lump sum invested at a peak of 2017 would have taken years just to recover. That's the power of systematic investment plan. Not just convenience, but true risk management. The third parameter for strategizing is asset allocation. This is a safety net. Most investors think of small cap investing as how much money should I invest? Should I invest 10%, 20%, 30%? But the smarter way to is considering these three factors, that is your age, market cycle, and your risk capital. Let us look at the first factor, that is your age. In your 20s or 30s, your biggest wealth isn't your investment. It is your career. It is your earning power. You can take more risk. So yes, 15 to 20% in small caps makes sense. If you're in your 40s, you have built wealth but responsibilities rise. That is home, kids, EMIs. Here small caps should be reduced to 10%. And if you're in your 50s or above, that's the preservation mode. Your goal is not to take bets but to protect wealth. Keep small caps very small, that is say under 5%. The second is your market cycle factor. Don't just look at your age but also market cycles. For example, in 2024 to 25, small cap valuation are at high records. That's not the time to overload, even if you're young. But when market crash like in 2018 or the COVID crash of 2020, that's where you should add. Downturns are where real wealth is built. As John Templeton famously said, the maximum time for pessimism is the best time to buy. The third is your risk capital factor. You should put your amount in small cap funds that you're ready to lock for next 7 to 10 years. Think of it as your venture capital inside your mutual fund portfolio. If you need money in 3 years for your car or 5 years for your wedding, this is not the place to invest. So instead of blindly fixing a number that is 5%, 10%, think dynamically. Age, market cycle, risk. That's how institution manages money. The fourth strategy is your entry and exit. See, you do not have to fully stay loaded in small cap funds. When valuation are too high, meaning stocks are priced way above their earning, that's a red flag. For example, in early 2018, Nifty small cap PE had crossed 100 in some cases. Then what happened next? The index crashed almost 40% in a year. Anyone who had reduced exposure back then saved themselves with a lot of pain. But what happens when market crashes? That's actually the best time to step up your SIP. Take March 2020. During the COVID crash, Nifty small cap index fell over 40%. But investors who increased their SIP at that point saw their portfolio double by late 2021. Think of small cap as a spice in your food. A little can make it exciting, but too much can burn your mouth. And the trick is knowing when to add and when to hold back. So yes, the opportunities in small caps are massive, but remember, in investing, reward doesn't come for free. The same factor that help you created wealth can also bring in risk, and that's exactly what we need to talk about the next. So let us talk about the other side of small cap funds, that is the risk factor. Small cap funds are like a roller coasters. When the market goes up, they can rise twice as faster, but when the market goes down, they can steeply fall down. For example, during the COVID crash in March 2020, the Nifty small cap fell 40% compared to about 25% in Nifty 50. Imagine your 100 lakh portfolio suddenly becoming 6 lakh. That's the kind of swings you need to be ready for. The second risk is liquidity. Unlike large caps, small caps do not have large buyers and sellers. So when big investor exits, prices can crash instantly. This means if you withdraw your money during market downturn, you may not get that great returns. That is why small cap are not for short-term money. The third risk factor is overvaluation concerns. Even SEBI has stepped in with a warning. In 2024, SEBI highlighted that small cap valuation are running too hot, with many stocks trading at 60 to 70 times earning. To put that in perspective, large caps usually trade around 20x earnings. Such stretched valuation means there is little margin of safety if growth slowdowns. The fourth risk factor is history repeats. And finally, let us learn from history. In 2017, small cap funds delivered 50% plus return in single year. Investors rushed in, but in 2018, the Nifty small cap index crashed. Many retail investors who entered late lost heavily. That's the cycle of small cap. There is greed and fear. So coming to the bottom line, small cap mutual funds holds a lot of potential in generating long-term income, but it can also destroy your investment if you plan without a strategy. Now, if you want to take action, let us look at some of the top performing small cap funds that you can consider. I'll directly show you on Fincash Explore Fund tool, where you get exposure to various parameters and options. So as you see, we are now on Fincash page. We will click on the Explore Fund option. On the extreme left side, you will see category, you will see fund house, AUM, and so on. We will click on the category, and within the category you will see all the mutual fund options. Now we have to check small cap. So we will click on equity fund, and within equity fund you will see small cap has an option. On the extreme right side you will see customize fund field, where you can select the criteria for which you have to explore the funds. Currently I have selected Fincash rating. Since it's a small cap, I have selected 3-year CAGR return, AUM in crores, fund age, and expense ratio. We will click on apply, and here you will see some of the best performing small cap funds. You can check them out, compare, and choose what best fits your risk appetite, investment horizon, and your goal. And if you want to get a link of some of the top performing small cap funds, do comment as small cap funds and we will share the link with you. So let us conclude the video, and here we always say it is your money, invest it smartly.